of buying and holding can work if you've got stocks that have momentum, but to remove that risk, and this is the Money Investing Show, it's all about helping people de-risk and get a swing to the upside. I think an index tracker gives that benefit of the optimism of markets without the baggage or the albatross around the neck of picking a couple of duff stocks in there. So Buffett would be the poster child for buy and hold over the long term, and it's proven to be a reasonably successful story. And even when markets pull back, that's not a reason to go run for the hills. It's another buying opportunity. If I take an example of our Trader of the Year last year, Stuart and Jill Garrett, that's their philosophy. Is as the market runs towards highs is to start cashing out, which is the opposite from a psychological perspective of most people whose fear of missing out is making them pile in. They're starting to take profit off the table to be back in cash, and on that pullback, start redeploying that money at lower levels to get another swing to the upside. Hey guys, welcome to this week's Money and Investing Show. We're diving deep on trading emotion and psychology here because we're going to look at bullish investing versus bearish investing. What's the difference? And more importantly, how can you make sure you're on the right side of the ledger at the right time? There's plenty of information to take out of this session, but most importantly, don't take notes, make sure you take action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Good to be here, Mr. B. Now, we've got a really fun yet informative podcast in store for our listeners today. Going to talk about the psychology of markets. Are you a bull or are you a bear? Big question to ask yourself if you're an investor.
Indeed, pivotal, because only one half of the equation is likely to be right. So I guess the first place to start, what's the difference between being bullish and being bearish? So bullish is where you expect the stock market to rise over a period of time. Bearish is where you expect it to fall over a period of time. So
it's funny, I actually only recently found this out. I always knew what bullish and bearish meant, of course, having a finance degree and working in finance.
Finding out about New Holland or New York as it was.
Right.
Used to happen there.
But apparently, so a bull attacks upwards, hence the bull market, and then a bear attacks downwards, hence bear market.
That's right. So bulls go up with their horns and bears strike down with their paws. And
Quite
it used
clever,
to happen
isn't
in a pit at Wall Street, of all places, in New York. Yeah.
There you go. Okay. Well, let's talk about the psychology of each. So
I wasn't there. This is before my time.
It's before your time. You've been around for a long time too. So bulls versus bears, AB. So if we talk about the overall bull market philosophy, I'm a self-proclaimed long-term bull. Markets do trade higher majority of the time. There's an upwards bias. What's the philosophy there?
I think that's it in a nutshell. People, human beings, and I guess we're talking about society, we're talking about the psychology behind it, so you've got to acknowledge what that psychology is, and invariably most people by their very nature are optimistic that tomorrow is going to be a better day than yesterday, so to speak. And so that's where this optimism that markets are always positive over the long term really comes from. People have a skewed bias towards things being more positive in the future. And as far as the stock market is concerned, of course, that's been largely the case. If you look at every correction that we've had through history, markets have recovered to new highs. Not necessarily as quickly as some would hope. You take the GFC, which was a pretty savage sell-off. It took the Australian market 12 years to recover from that. If we look at the dot-com boom and bust, it took the Nasdaq, I think, nearly 15 years to recover from that. And in the case of, say, the Nikkei, which peaked out at 38,915 points on the 31st of December 1989, there's a bit of trivia for you. It's never regained those highs, so it's failed to get back to that level. And part of the reason for that was a bubble, but also some of the structural challenges that are going on within the Japanese economy and the Japanese market. So invariably they do recover, typically, not always, but invariably they do. And so that's a feedback loop, if you will. If you're someone that's optimistic about markets and market always recover, well, the evidence is there to support that view.
So question for you, think about two elements here that come to my mind. One's inflation and the second is corporate earnings. Now, if we've got inflation, that means prices are rising overall for consumers and businesses. It also means that corporate earnings are likely to grow as well. How does that relate to an overall positive bias long term?
Well, again, earnings are what drive prices. If you think about the price earnings multiple, a company is going to be priced at multiples of what its earnings are. So if its earnings are increasing, its price exponentially is going to increase by more too. To put some nuts and bolts on that, and I don't want to dive because obviously this is a podcast. If we had a whiteboard or a spreadsheet behind us right now, it'd be a wonderful point of reference. If a company is on a price earnings ratio of 20 times, in other words, its price is 20 times its earnings, and its earnings improve by 10%, the amplitude is multiplied by 20 if it's on a price earnings multiple of that. So that 10% move in earnings times 20 is what's going to effectively happen within the pricing mechanism. So you can see how share prices typically push ahead because of growth in earnings, and earnings grow because of the company in itself growing. And as you say, with inflation, that usually is something that helps boost earnings for companies too, because they're in a stronger economic cycle.
So strategies for bull market investors, if you classify yourself as a bull, we talk about markets going higher over the long term. Is it about taking a long-term approach, almost like a real estate type play where a buy and hold forever?
There's a lot of merit in that argument, and I mean, if you think to some of the sort of poster childs of, well, I can't really call them a child, of a bull market, it would be somebody like Warren Buffett, where it's all about the buy and hold philosophy. Buy good quality blue chips, hold them over time, they go up in value, which is probably the biggest sort of poster child of that philosophy, and it's been incredibly successful. It's one of the world's most successful investors. The strategy hasn't worked so well over the last sort of 5-6 years when you look at the performance of Berkshire Hathaway as a whole. Is that because of the sheer scale of its business, or because markets have changed a little bit? And I think it's probably a combination of the two. We've had, for example, a really strong run in the technology sector, which Berkshire Hathaway probably hasn't had as much exposure to as it perhaps would like, and so it's been left behind a little bit there. Do you describe tech companies as blue chips? Yes, no, maybe. Some of them are. Some of them are more speculative. And if that's where the growth has been, that sort of blue chip filter may have knocked some of them out.
So my next point to that, if we talk about stocks or not, so for example, ETFs, right, which might be a roundabout way of getting long-term exposure without the stock-specific risk. We're currently in market conditions, without dating this podcast, where a lot of stocks are trending lower, but the indices are at record highs. So if you're a bull market investor or bullish investor, so to speak, you could just buy the index for the long term, right?
I think buying an index, as I've gotten older, and my predilection for wanting to trade ETFs has been most certainly something that I think it offers tremendous value. Here's an interesting anecdote for you about bull market. So if you take iPhones. Now, if you bought every model of iPhone since their inception, you would have spent, I think the number's about maybe $25,000 ballpark.
US, Aussie?
US, Aussie, I'd say US.
Yeah.
And I could well be out by a magnitude on that, and I'm sure there'll be somebody that's going to have the cardigan on at home studying these
Point
figures.
is, it's a lot that you've
So
spent.
if you bought every machination of the iPhone, every upgrade since it's come out, you spent about $25,000 on your iPhone. Now, if you'd have bought $25,000 of Apple shares when it started out as a business, you'd have a portfolio that's worth $300 and something million.
Wow. Oof.
So
that makes me cringe.
So what that shows you is, yes, the products have got more expensive, people have continued to spend, the earnings growth is coming, but the trajectory of the business has really taken off. So when you find companies like that, holding them for the long term makes an awful lot of sense. Now, there is a yin and a yang in here. If you take something like, say, AT&T, the telco in the US, or General Electric, and you've held those within your portfolio, they've both been perennial underperformers because they've been archaic businesses in many respects, in perhaps the same way that Telstra has as well with its fixed line business. AT&T has been sort of beset with the same issues. If you take GE, General Electric, back in the 80s and 90s under Jack Welch, arguably the most high-profile and successful CEO in history at the time, at least, it was the go-to holding, yet it's perpetually underperformed since that period of time, given some of the business decisions, gearing levels, and so on within its business. So there's an example where that bullish optimism of holding a stock hasn't worked. And I think when you look at stock examples like that, it does underpin for a retail investor, Joe Bag of Donuts, anyone listening to this that's new to markets, to buy an ETF that's an index tracker instead, so you avoid the risk of going, look, AT&T is a household name. General Electric, read Jack Welch's book, fantastic, must be a great business, let's get some. And then in a number of years' time, find that you've held stocks that clearly haven't kept up with the market. So in this environment, I think, that bullish exposure via holding an index is a no-brainer for many, many people. And it's one that's delivered great results. I mean, let's face it, the S&P was up 25% last year. The NASDAQ was up over 54% last year.
Crazy.
Okay, and it's been driven by a small number of stocks. We get that, NVIDIA being a big component within that, the Magnificent Seven and so on. But nonetheless, you've been able to have exposure to that. It doesn't matter why, you still made the money.
Can I tell you something crazy about NVIDIA I heard this morning, and it's relevant to the podcast, but not crazily. NVIDIA this year has had 7 million options contracts traded on it just this year. 5 years ago, that would have been the number of options contracts traded in the entire market for the entire year.
Wow, that's a
busy
that's
stock.
crazy. How much of that was us? Quite a bit, I hope.
It would have been a lot, yeah.
So, this notion of buying and holding can work if you've got stocks that have momentum, but to remove that risk, and this is the Money Investing Show, it's all about helping people de-risk and get a swing to the upside. I think an index tracker gives that benefit of the optimism of markets without the baggage or the albatross around the neck of picking a couple of duff stocks in there. So, Buffett would be the poster child for buy and hold over the long term, and it's proven to be a reasonably successful story. And even when markets pull back, that's not a reason to go run for the hills. It's another buying opportunity. And if I take an example of our Trader of the Year last year, Stuart and Jill Garrett, that's their philosophy. Is as the market runs towards highs is to start cashing out, which is the opposite from a psychological perspective of most people whose fear of missing out is making them pile in. They're starting to take profit off the table to be back in cash, and on that pullback, start redeploying that money at lower levels to get another swing to the upside. And I love that philosophy. It's very unemotional, it's very mechanical, and it's extremely effective.
Indeed. Change of pace now, AB. Let's talk about bear markets. So bear market philosophy, how would you pin that?
Look, bearish markets, they are going to happen, and you go through phases in the big cycles within an economy where stock markets don't perform, where, if you go into recessionary conditions, companies can't generate that earnings growth. They are laying staff off. Sales are slower, profits are thinner, if not losses being made. And those are the sorts of conditions that see markets revalue, and you start to see that longer term downtrend. But bear markets don't last forever. You see a bull market, and it'll run and run and run for literally years and years. Whereas a bear market typically is, markets go up the staircase and down the elevator shaft is the old analogy.
Indeed.
So a bear market typically is quite quick, partly because of the panic reaction of people in the market when they see that. And it becomes self-fulfilling insofar as if prices start to fall, you think, I'm getting out before it's too late. By selling more, you're pushing prices lower because that's effectively what's going to happen if the quantity or supply side of stocks to sell is higher than what's available on the buy side. You're going to drop your price. You can't have more sellers than buyers. You've got to have the same amount for there to be a transaction. But the pressure to lower the price in order to be out first is there, which then capitulates markets further and further down, which is why bear markets typically happen very, very quickly. It's a major psychological thing. It's like, hit the exit now. It doesn't matter what I get out for, just get me out.
So bear markets, they're harder and faster, they're shorter in time. What kind of philosophy do you apply to that from a trading perspective or an investment perspective?
Look, you're going to get caught up in them if you're a long-term investor, and if you try and time the market, it's quite challenging. And the chances are, if you got out because you think the market's going to drop, by the time you see enough evidence to get back in, it's probably recovered where it was or more, and you've missed out on that recovery play. It's
Classic.
nice and we've got some really good tools, like our signal screen is actually pretty good for picking those lows, don't get me wrong. But for most retail investors, that's probably a step too far. That's why having help with people like our team makes an awful lot of sense. I think also the psychology of it, I think you can ride a bear market out if you want to, because your stocks, if you've got an optimistic bias, will recover. I think it does make sense to unload your positions and buy back in for sure. I also think, typically people that are bear market traders intellectually, and I don't know how much evidence there is, but this is sort of my gut sort of feeling on experience, people that trade bear markets comfortably, I think, fancy themselves a little bit more intellectually, that they can see something that other people can't. They're able to react to it and respond more quickly and decisively and make money from a scenario where most people are struggling. So intellectually, it draws a certain type of person into that, a contrarian, for example. And that can be very, very helpful because when those scenarios present themselves, seeing it for what it is, being quick to act on it makes money. Where it becomes a bigger problem, or becomes a problem in the first instance, is when you've got someone that's perpetually bearish.
The perma-bear.
The perma-bear, where you've got someone that's typically pessimistic. And they're usually pessimistic about life too, because the way you do anything is how you do everything. So if you're optimistic about the market and its future, you're probably a reasonably optimistic, glass half full rather than half empty type person. When you've got someone that's perpetually, this market's going to crash soon, and I can give you two very good examples of that. One would be Harry Dent, the US economist. I've spoken alongside Harry. We had a little bet when I spoke at his Irrational Economics Summit in Vancouver, which was 9 years ago now. And his call was that the Dow would be at was it 6,000? And I said it'll be at 30,000 before it gets to 6,000. Now we're at 40. I haven't collected
Long
on that
way
yet.
off.
And he's someone that perpetually pushes the barrow for the bearish side. And he's caught a couple of great things in his career, don't get me wrong. You know, the demographic shifts, I think that some of the work that he does there is excellent. However, and if this feedback gets through, it gets through, and I'll stand by it. Even a broken watch is right twice a day. So you can eventually turn around and go, see, I told you the market was going to crash. And if it was from the current levels around 40,000, for example, and you saw the market drop to 25,000, you'd still be ahead of where you would have been if you'd have cashed out 9 years ago waiting for it to hit 6,000, because you can't fight that optimism of society. So there's an example of someone that has a strong view about being almost perpetually bearish. The other example that I've had someone that's worked for me that was the same, and it was just like, it's going to crash, going to crash, going to crash, and we're in the middle of a great bull run. And in the end, I let them go. And it wasn't because I don't foster, as you guys know, discussion and people of different personalities and different analytical approaches. It's that pure negativity that actually started to get the team down, going like, would you just shut up? You know, you're wrong. Your ego and intellect is getting in the way where you're expecting this bearish pullback. It's not happening, and it's costing the clients money if we don't get them into bullish trades on this, waiting for a pullback. So you've got to be very, very careful. You can't be permanently in that frame of mind. I think you've got to look at what the signals are, and when they present themselves, take the signal, like any trader, be disciplined. But if the signal, you can't just perpetually have a bearish signal out there looking for a problem, because there's no way to live. It's a miserable existence to be around you, and it's also extremely expensive in terms of opportunity cost from an investor perspective. Yeah, we mentioned Warren Buffett at the start of being the poster child of bullish investing and long-term view. Michael Barry would be a good example of a bearish investor through The Big Short. We spoke of that a few weeks ago in a podcast. But also going back in the midst of time, someone like Jesse Livermore, who was one of the very early famous traders, I suppose, on Wall Street that learned to read the tape and really had quite a profound impact, I think, on a whole generation of traders. So some of the books largely around his life, one would be The Reminiscences of a Stock Trader. So this is in 1907.
Oh, wow, it's a long time ago.
So he made $1 million in one day back in 1907. Which
for himself or for the firm?
For himself, which is a truckload of money.
Holy smokes.
And particularly so then. And this is someone that was known as the Boy Bear periodically, and had that, but that was in the 1907 panic. And so had a very good knack of trading markets to the short side. Interestingly enough, and there are a number of books and things that have spilled out about Jesse Livermore over the years, but he committed suicide very sadly. There's no way for anyone to finish their life on the planet, for sure. And the reason for his suicide was because he was bankrupt. So
it's very surprising.
Much for making money in bearish conditions, or $1 million in a day. Overall, he ended up, I think it was like $3 million of debt and 85 grand's worth of assets, and couldn't handle that failure. So overall, it didn't pan out particularly well. And I think that reflects the difference between having that optimistic outlook on life and that pessimistic outlook on life, where you're looking for a crack to jump on to profit from.
So it'd be fair to say, if you are going to trade to the short side, typically shorter time frames that you'd be looking at.
Massively so, which then when you look at your analysis techniques, and if we go back to Harry Dent for a moment, if you're a short-term trader, the biggest ingredient in your trading decision, as we know, is going to be your technical analysis, not fundamentals. Because fundamentals are big, slow-moving pieces of the jigsaw puzzle. And if bearish markets are on a snap and short and quickly, then your skill set, as per Jesse Livermore, great at reading the tape, need to be around that technical analysis. And the fundamentals may support your argument, but it's a technical trigger, which effectively is going to be the reason why markets drop down an elevator shaft. Breakout of war, major economic factor, like we saw with COVID, a global pandemic, an assassination of a major world leader, something that's a real derail that brings everyone to a halt, to go, wow, what was that? Bang, market responds in just a handful of days. Corrections in markets, which become bear markets, are a little bit different. They're not event driven. A correction, if you think about, say, the GFC, was just a purely overvalued market, and you had so many opportunities to take your money off the table before that rounded top and head and shoulders and everything else kicked in, and you started to see that capitulation, which is where then the panic happened, and it became self-fulfilling, where the savage sell-off really happened, when everyone's just saying, get me out, I don't care about price, just get me out.
Indeed.
And as a broker at the time, that was an interesting time to be on a trading desk.
I can imagine. I can imagine it was just as bad going through COVID. That was when I started my career, was when that bear market hit, and gee whiz, that was hard and fast.
It's big volume because people are just, in that instance, people are looking at through one of two lenses, or either just get me out, in which case there's big turnover, which as a broker is a good thing, I suppose. And then on the other side of the coin, you've got the opportunists that are sitting back going, okay, yeah, if this hits this level, start buying for me. So it's typically a great time to be a broker through that time frame.
Indeed.
Because there's activity within markets. Unfortunately, the flip side of that is there's a collateral cost in terms of clients, which if we come back to tin tax is why we focus so much on education, because when you hit the exit button at any price, that's just that red mist of panic that's come down and you're not thinking straight. And we all know, particularly with the training that we provide our clients, that there's no room for emotion in the financial decision-making space. It's about seeing what's the game plan that you built for this occurrence. And it may not be exactly for that occurrence, but it's for broadly around that occurrence. So if market's dumped by 15, 20%, what do I do? Not panic, hit the exit button, do your backside, never go back to the stock market again because it doesn't work. What didn't work was the strategy you had, or the decision making around that strategy that you applied.
So question for you, AB, as we come to the end of our podcast, that's all really good information. I think we'll provide our listeners some good context, both sides. The notion of removing emotion is harder, easier said than done, I should say. What's the advice to those out there, whether you're a bull or a bear?
Get educated, first of all, massively. The best investment you ever make is in your education. Learning how to make high quality objective decisions, particularly during faster moving markets, which can be challenging. You do have to be decisive, which, in my experience, most people don't like making decisions full stop, let alone quickly. So it does become a little bit of a challenge in that context, where you're asking people to make a decision fairly quickly. And if you haven't practiced for that, and sport is a great parallel for life. If you think about the majority of what you do when you train for sport is endurance, fitness, you got all your conditioning work, your stretching, and when you're on the practice pitch, or oval in your case, it's about running the drills, and this is how we're going to play the game. And then there's that little carve out at the end about your special situations. For example, okay, we get a penalty in this area of the field, this is who takes it, this is where it goes, this is where my decoy runners are going, and you've practiced that run through. I could still call football moves from 30 years ago, where we'd have a special move if we were inside the opposition 30, not 40 or 20, but 30, and what we used to do and what it was called and how it went. I could tell you that now because we practiced it so many times. It was just drilled in, so that when you're on the field of play and you're out with 30 out, what are we doing? It's a raining bang, off we go. Fullback's coming in on the scissors through the middle, decoy runner either side, gap opens up, and 6 times out of 10 you're going to score a try. But only because you practiced that. Now, if you went through the same level of practice and diligence as I know you did with your football career, and brought that to your trading to say, okay, if X, Y, or Z happen as an event, my first go-to response is to do this, or this, or this. So I've got 3 pathways I can take if this event happens. And that event could be anything: an outbreak of war, an act of terror, a very unexpected election outcome, some really significant economic data. Now remember, I said fundamentals are typically long term, so you wouldn't just get one out of step piece of data. There's usually a lead into it. All of those sorts of things that can give a knee-jerk reaction to markets are things that you can loosely plan for, to say, if any of this bucket of problems come along, I either do this or this.
Yep.
So that when that particular problem happens, you're not going onto Google or calling our support team going, oh, this has happened, what should I do? It's too late. You've got to be able to respond more quickly, and more importantly, to back your decision making at that point in time. And there's a good chance you could be wrong, and that's okay. You can be wrong. There's nothing wrong with that, and there's that pressure we put on ourselves never to be wrong. And the easiest way to avoid being wrong is to do nothing, which is just about the worst thing you can do in those sorts of scenarios. So an acceptance that you could be wrong, but if you practice enough, you're probably going to be right, because you're not making a rush of blood to the head kind of decision. And you're going to reach into the kit bag and go, okay, I could buy options, probably going to be a bit expensive if volatility is kicked on. I could buy a bearish ETF, which is going to give me a partial hedge, or indeed a hedge, depending on how much I do. I could sell everything. There are 3 courses of action that are practical that you could take. As I mentioned, buying insurance probably prohibitively expensive at that point in time. Selling everything is, if you think the market's going to carry on falling, is one way you could get out, and if your view is right, then you've saved yourself some money, or better yet, just dynamically hedging by getting short the market and profiting from that sustained run down, which preserves the value of your portfolio, because what you lose on your long positions you're making up on your shorts, and net that's it, sort of cauterized at that point in time, and the damage is kind of done, and you can, glad we got that done. And you go, no, but what's a bearish ETF? What's the code for it? Is that one geared? Can I do that?
You have to know the stuff in advance.
You've got to work it out, so you've got to know where you're going. And if you proper preparation, as we often say, prevents those poor performances. And it's crucial. It's absolutely crucial. So, this is all about psychology, pure and simple. And understanding, as we said right at the start, human nature is eternally optimistic, fortunately. That's why we live in a great society, even though it has its challenges, by and large it's a great society. And every now and then there are going to be events that come along that change the lens on that and make it a little more pessimistic. And when that happens, okay, there's my bucket of things, or my kit bag of things I do when the pessimism index kicks in, and I respond in that way. And then when that's done, let's get back to putting the happy lenses back on and seeing optimism again. You can't live in that pessimistic space, because markets will crush you. You'll be wrong, particularly given the bias that markets typically go up over time. And you got to ask yourself the perennial question: do you want to be right, or do you want to be rich? And if you're someone that's just looking for a pullback in the market all the time and it's not happening, you might say, I'll be right, but you're missing out on a fortune. Better to be in and managing than on the sidelines looking for the crack.
Indeed. Great advice, AB. Thank you very much.
My pleasure. No problem, anytime. If there are words or phrases in this podcast that you don't fully understand, or perhaps you're someone that's looking to generate strategies to help build your wealth, make sure you visit wealthplaybook.com.au and grab your copy of our latest best-selling book, which is absolutely jam-packed with strategies, techniques, and most importantly, checklists that will practically give you a guide to create tomorrow's wealth today.